Hi, everyone, and welcome again to the latest edition of the Optimum Tide podcast. We have a very special edition today, one because Anastasia is not present. I'm actually filling in for her. She's out on vacation right now. But we also have a very special guest, which is one of our very own, the very talented Mr. Michel Hébert, who I've had the pleasure of working with and learning from extensively over the past few years in pricing. I myself, Terrence Weiser, I'm the head of business development for Optimum Reinsurance Company in the U.S. market. And so when pricing and business development get together, it usually seems like it's going to be a gridlock, but our teams work really well together and it's always been a joy. So I'm really excited to have the opportunity and honored to present here today with Michel. So Michel, maybe you can tell us a little bit about yourself and your tenure with the company.
Yes, thanks, TJ. So I'm the Senior Vice President of Pricing and R&D. So I've been with Optimum for 15 years in various actual roles, and now my role is both on the Canadian side and on the U.S. side. So really happy to participate to this podcast with you.
Perfect. And this is a very special podcast and near and dear to me because I've worked closely with Michel on this project for the last couple of years. But over the last 2 or so years, we did a big rebranding campaign for our company, focusing on our actuarial and underwriting expertise. And Michel, being in charge of actuarial for us, he put a really great team together, which he's going to elaborate on here in a little bit, to go over our Pearl model, which is our Predictive Expertise Actuarial Research Lab. I'll let Michel kind of go over that a little bit and explain the genesis of it and his team.
So maybe talking about the history of our department. So when I took over the research and development department a few years ago, one of the first thing that I did was to take the Society of Actuaries Predictive Analytics Certificate. So that's a pretty hands-on course. And when I took that course, I saw that it was going to be a game changer in the way that the industry is going to analyze the data. So that's why I decided to put a lot of emphasis in our R&D department on predictive analytics. And over the years, we started developing first our predictive model on travel insurance. So travel insurance is one of our niche lines of business in Canada. So we developed a model in order to predict the incidence rate and the severity of that line of business using traditional, but also having new variables that are heavily predictors of the incidence rates in that line of business. And then we developed a predictive model on final expense. So final expense is funeral business in the US with very limited underwriting. So we were able to really highlight and find good variables in order to predict that line of business, but also to be able to find, okay, what is the difference in mortality from a client that has a more stringent application, so more stringent health questions that are asked, versus another client that would have maybe a looser underwriting. So we were able to go there and put a mortality number to what is the impact there. And then also in fully underwritten and accelerated underwriting business. So this is the bread and butter. So the most lines of business that we currently do in both US and Canada. So we develop good models to predict the mortality of it. And currently we have an ongoing project for a simplified issue in Canada because there is no industry mortality table for that line of business. So we will be developing that. So the goal always had in mind that what we want to do with these models first, of course, is to help Optimum define assumptions. But I also want to make sure that we had something for our clients. So we want to help our clients. Optimum is a service company. So it was important for me that our clients get something back so that they can really benefit from all of our expertise.
Yeah. So kind of like benchmarking services that we're more leaning towards based on different underwriting programs that we're looking at. So, and as you just discussed, our focus at Optimum Re is to provide valuable guidance in order to maximize profitability for our clients and to showcase that to our prospects. So Michel, with that in mind, then how does all this fit into the goals of our clients and others in the industry that we've heard that have a need for this?
Well, everything that we do, we want to help our client optimize their profitability. So as I mentioned, we've done many predictive work over the few years now, and we gain a substantial expertise in developing them. And we want to share that expertise with our client so that they have a better understanding of the mortality experience so that they can take the best decision to optimize the profitability. So, of course, the goal that we want our work to be useful for our clients so that also it addresses their concerns. Because in a recent survey of life insurance executive, their top priorities that they were mentioning was centering around growth, automated, accelerated underwriting, expanding distribution, accessing new markets. So the service that we offer with the Pearl program, it allows those insurance companies to tackle those priorities while at the same time doing it in a profitable manner.
So one of the things you mentioned there, and I've actually seen that and heard that also from other executives that I've talked with within the industry, but can you elaborate more on how analyzing these markets and distribution can help with growth and other avenues with that standpoint, being that this is more of like a profitability, benchmarking tool? Can you kind of elaborate on how that works?
Yeah, well, these clients that want to grow and access new markets, like I mentioned, there's some uncertainty involved in that. And what is going to be the mortality experience from these new sales? They cannot just rely on past experience and assume that these new markets, the new sale will yield the same or similar mortality. So these new sales, they could come from new distribution channels. So the new distribution channel could mean that they might attract different applicants, maybe with different issue ages. Or they might grow in geographic region like a state or a province where they were not selling much before. Or certainly just a distribution of business between rural versus urban. That's also a big difference. Or simply, they could just change their underwriting requirements. They change their age and amount requirements or change the underwriting tools. And all of these changes can have important variations into the future mortality that they might have. So the work that we do is we give the knowledge back to our clients so that these companies can maybe put incentives in place to optimize that profitability, or at least know what they should expect.
Mm-hmm. Yeah, and it's also interesting because we've worked with a couple of clients so far on the Pearl program, and one of the things we're also hearing is that they like to have the data and the package that we put together for their board or for their executive team leadership to also kind of help with those decisions as they're growing and moving into those markets, and especially in accelerated underwriting as well, because that's a little bit more newer and a lot more nuanced on things you have to look at. So you're providing more granularity as well on what normally some companies would actually view when they're viewing their book of business.
Exactly.
Right. Great. So then it sounds like obviously you've made a lot of work to construct these predictive models, but can you explain, what's behind all of this?
So in Fully Underwritten, we have developed two models. So one for the US, one for the Canadian market, with exactly the same goal, was how do we adjust the industry mortality tables? And the work showed that, these industry mortality tables are good in aggregate if you adjust them for the overall level, but there are significant variations that are needed by issue age, by duration, and you also need to account for new variables that are simply not present in the industry table, like the type of product. So permanent versus term products, mortality can be different. And also the tables, they don't have face amount adjustment. And we know that the misrepresentation is different and more prevalent in the lower face amount. So that's why our predictive model show a shape of mortality in the first few durations that are different by band. More generally speaking, is that our best estimate of mortality is not a flat percentage of the industry table. So if companies are currently not using predictive analytics to derive their mortality assumption, I think they could be very surprised of how much they need to adjust that current best estimate to really fit the mortality in all areas of the curve. To give an example, when we introduce our latest predictive model or the assumption for our fully underwritten business, the overall result didn't change much. But we had to lower in some areas of the curve, increase in other by factors of 10, 15, and even more than 20%. So companies are exploring growth and they're not using predictive analytics. they could have a mortality experience significantly different than what they expected. To give an example, if they're using a too simplistic assumption, they could maybe expect a mortality, say, of 100. But if they had a more precise assumption based on predictive analytics, then this expectation could be 5, 10, or maybe 20% higher. And on top of this, if the companies want to grow, let's say, in a new geographic region where this mortality might be 5, 10% higher, then the results can be significantly different than their initial expectation using that too simplistic assumption. And if you combine that, that could mean that it could wipe a significant portion of their profit from their business that they're trying to grow. But with our Pearl program, Optimum, we can really help our clients anticipate the right mortality and avoid those bad surprises.
Yeah, and it sounds like especially middle market companies would really benefit from that too, who are kind of more moving into the accelerated space or looking for finer tuning on their assumptions. But obviously, large company market, we'll talk a little bit later about some of the future plans that we want to do with Pearl and how that also helps with those companies as well and those carriers. But can you go a little bit further about how you concretely do this?
Well, the first thing that after we receive the client's data, the first step is really to benchmark the sales distribution versus the industry. And so it seems basic at first, but it's important to keep that in mind because later on, when we see variations in mortality, sometimes just a difference in sales distribution can explain why they're seeing different mortality. And then what we do is we benchmark the client's experience to our base predictive model. So our base model can be viewed as a proxy of the industry's mortality experience. So at this point, this is just traditional actual to expected. So there's nothing fancy yet. But where it gets really interesting is in the next step. So based on these deviation of the client's experience to the industry, this is where we built a customized predictive model to reproduce accurately the client's own mortality experience.
Yeah. And what kind of results are the clients going to be getting from this type of analysis then?
Well, we provide them really a complete report. So we benchmark, as I said, the distribution of their sale versus the industry, traditional A over E, so that they can validate the results that we give them in line to see if it's in line with their own results. And then we give them results of our predictive model. When I mean the results, I mean we give them a fully customized pricing assumption to derive their own experience. So they could use it. And when we give them those results, then they could see where are we having differences compared to their current assumption, and then be able to use their own data just to validate that the assumption that we have derived is an improvement compared to their previous assumption. And on the slide you see here on the screen, it's kind of the results that we show our clients to explain where their experience deviates from the industry average. And these results are based on predictive analytics, meaning that there's no double counting involved. Because when you're using traditional A over E, if you're only looking, for example, by face amount, you might not see that the mortality has a high face amount because high face amount usually involves also higher issue ages. So you might be missing out something, but when you're looking at predictive analytics, it can capture separately the effect of issue age and face amount. And this is what we're seeing on this mock report that we show to our clients is we would say that the business with face amount in excess of 2.5 million, has a better mortality than the average industry by 5%. And another conclusion that you see on the screen is that the mortality of issue age 75 and plus is 10% higher than the average industry. And these kind of conclusions can lead to tangible actions because there is a client that we showed those results and they were experiencing higher mortality in the higher issue ages. and they decided to limit the issue ages because they seemed to be getting anti-selected at those very high ages.
Yeah. So really just offering the guidance of how to adjust their business model so that they will have a better outcome at the end. So then what about accelerated underwriting? Obviously, this is a big trend. A lot of companies are transitioning, if they haven't already, into this type of model or doing some hybrid approach. How can this program help with those particular carriers?
You're right. Accelerated underwriting is a big trend for a few years now. And so what we're really trying to do is help our client understand the cost of such program. And the cost, what we refer to the cost, is the mortality slippage. So just to be sure I'm clear, we're not trying to determine which policy should be accelerated. Companies are already doing this, and we don't pretend to be able to do it better than them. What we're focusing on is how can we measure precisely the slippage from their accelerated program. So most companies currently are using what we call a confusion matrix in order to estimate the mortality slippage. So they're looking which risk class was assigned with only the info from accelerated underwriting, and with the additional information that they're getting from either random holdout or post-issue audit, they're looking, okay, did the risk class change? And then based on assumptions on the difference in mortality from one risk class to another and the percentage of business that are wrongly classified, this is how they estimate the mortality slippage. What we do is we look at the actual claims and we compare those actual claims to our customized predictive model that I talked earlier, so which represents the carrier's own experience. And so by comparing these two, the actual claims and the predicted level of mortality, then we're able to measure how much additional mortality a company is experiencing from the policies that were accelerated. So, and our goal is not just to give an overall mortality slippage, but it's to see also how this slippage varies by the various variables that we discussed earlier, such as the gender, the issue age, the face amount of the risk charge. So with the information that we give to our clients, we're doing actually a cost-benefit analysis. So they're actually having all the really good idea of the real cost linked with the mortality slippage, and they can therefore take informed decision. And this is not just something that we do one point in time. So we're offering our clients to do this on a regular basis so that clients can also see, is there any positive or negative trend that's happening in their accelerated underwriting program?
Yeah. Yeah, and also I'm assuming then, working with those companies on providing this type of value, we're also kind of working with them on how to get the data and how to change the way that they're, viewing their business going forward to make this a little bit more routine and easy, because it's very important for these companies to really monitor everything that you're stating here. But one thing we didn't really get into is what about the auditing process usually going with accelerated programs? So a lot of companies, obviously, to measure slippage are looking at random holdouts or post-issue audits. Do you think this leads to a good enough estimate?
Well, the quick answer is it depends. It can be a good estimate, but in other times, it could be not. So some are using a random holdout, as you mentioned. So that means that applicants are randomly selected to provide evidence, so like blood and urine analysis, and then fully underwritten is performed. So what's good about random holdout is that you're doing the screening before the policy is issued. So if there's new information that changed the risk class, then you won't get any mortality slippage on those cases. But the issue is that some applicants do not necessarily tell the truth on their application. So if you ask them, now you're randomly selected, then they're most likely to drop out of the process because they don't want to get caught lying.
Yeah.
So if your company only captures information on applicant that accepted to go through the fully underwritten and provide blood, then the population that is used for your random holdout might be different than the population of the policies that you issued. So that means estimating the mortality slippage from your random holdout could be an underestimation. With post-issue audit, means that most of the time companies are ordering attending physician statement or APS after issue. So companies are actually measuring the mortality slippage of actually placed policies, which is certainly a better estimate of the mortality slippage. But the trend right now is company trying to increase their straight-through process, so by allowing higher face amount or higher issue age. So it's important that companies that want to estimate their mortality slippage at those higher face amount or higher issue age, they're not only using the average of their whole, let's say, program, because the mortality slippage is not constant. And what I mean is that if a company want to expand their accelerated underwriting program from, say, 1.5 million to 2 million at an issue age of up to 60, then they should estimate the mortality slippage near that 1.5 million mark in the issue age 60, which can be quite different than the overall mortality slippage. So what we've seen in this industry is higher mortality slippage for males, as we know that males tend to lie a little bit more on their application. So these industry results that are showing on the screens right now show that males have a 40% more slippage than the average of both gender. So if the average, let's say mortality slippage is 10%, just to give a round number, and that would mean that the males would have a 14% mortality slippage, female would have 6%. And the same for issue age. So with the same example of the average of 10%, lower issue ages would be at 12%, while 51 plus would be at 7%. So that's why it's important not to only look at the total mortality slippage, but also look more detailed at where is it close to the threshold that you want to expand.
Yeah. So, kind of talking about different types of misrep and what we look at and what you're explaining here. So what you're saying is that in these conclusions are in line with the tobacco misrepresentation that we knew many years ago.
Yep.
And males and lower IA, issue ages have higher misrep.
Exactly.
Yeah. Okay. So then, Michel, obviously you're working in both Canadian and US markets, which are both completely different rules and regulations, things you can collect on data and so on and so forth. What are can you add some color to the big differences that you see in terms of accelerated underwriting in both markets?
Well, I think the biggest difference is certainly the access to third-party data in the US. So in the US, companies have access to what are the prescription drugs that an applicant is taking, or what are the medical procedures that they underwent recently. And some providers have developed predictive models in order to take all this data and then predict the expected level of mortality of these applicants. So they derived a score, and this score can also be used in order how to classify the applicants between the risk class, so between a super preferred, a preferred, and maybe a standard class. So of course, the US companies, they can replace this absence of blood and urine in accelerated program by the third-party data, so it helps to reduce the mortality slippage. And because the US can rely on the third-party data that gives them some level of comfort, while many companies prefer to use post-issue audit as opposed to random holdout, because they're less intrusive and they're more customer-friendly. In Canada, on the other hand, they don't have access to much data like in the US, and it's mostly limited to information on the application or what is self-declared by the applicant. So to keep the results under control and to see any negative trends that can happen, well, the companies are mostly using random holdouts. So they select a portion of the applicant, and these goes to fully underwritten. So they can provide blood and urine, as I mentioned earlier. So in addition to have developed predictive models, they have developed those predictive models to detect who's lying on the application. So if they suspect an applicant is lying, then they would fall within the targeted holdout. So it's not purely random, but they have models in order to say this applicant should go to fully underwritten because they suspect that this person is lying. So companies have started with smoker propensity model. So it's a model that is trying to detect who applied as declaring themselves as a non-smoker, but they're actually smokers. Then they went further and some developed BMI models. So in order to see which applicant are lying on their declared height and weight. And now more recently, some have developed a more general misrepresentation model and also models that try to predict if an applicant should be issued standard.
So this is all great and fascinating, but I guess my future question is, and this is something that I've heard a lot in the industry, looking long term with our Pearl program, what are some things that we want to do with it eventually once we get more clients on board with what we're doing and get more of that benchmarking service down? Thinking outside the box in terms of vendor review, and also the cost benefit analysis of understanding, because right now the biggest discussion we're hearing a lot from carriers is expenses, right? Everyone's trying to lower expenses, so you're talking about profitability. How does this could eventually help with that down the road?
Well, ultimately where we want to go is really help clients understand that really, is it worthwhile to have this additional underwriting or these additional underwriting requirements? It could be underwriting tools. So our goal is, with having all this data, how much can we value the cost or the mortality saving of having this tool at this issue age, this face amount, so that we can help clients. They know the amount of cost that it brings to have this tool. We'll be able to tell them, here's the mortality savings, so that they can make a really clear decision, okay, it's worth it or not.
And that's what excites me the most about it, because it seems like almost every other month there's a new tool coming out or something we're talking about. I know it's not that fast, but especially with the way things are going with AI and how these are moving, especially in the US market, I think you're going to see a lot more of that coming down the pipeline, and companies trying to understand how to manage those expenses, but also seeing, okay, what's the mortality impact of this tool, or how it can have an impact on my business going down the road. It's really great that they can be in this program, at least on an annual basis with us, so that we're helping them get to that and achieve those goals. So I think that's what I'm very excited about. But also, like I said, the whole benchmarking in general, I think that's something that we need to do a lot more of within the industry to make all of ourselves better. So this has been very fascinating for me. And Michel, I don't know if you wanted to say anything else in closing, but it's been great having you here. And yeah.
Yeah, well, I think the work that we have done is really fascinating. The clients that we presented those results were really happy with the conclusions that we bring them. So it's valuable conclusions, valuable knowledge that they can use in their day-to-day work. So look forward to working with many other clients in order to study their portfolio right now. But as you say, in the future, this is something that will continue in the future, so that we can, let's say, expand those conclusions as the program evolves.
Yeah. And again, for those who are watching, and we thank you again for tuning in. And if you want to get an actual live demo, we do have a live demo that we're doing now, especially on the accelerated underwriting program. We have one for final expense as well, but we know that accelerated underwriting is more the hot topic. And we've actually done a few of those demos. So if you are interested, please reach out to myself, Terrence Weiser, Vice President of Business Development, or obviously Michel, Hébert, and we'll put our teams together and make sure we get you a customized Pearl demo specific to your company's needs. So again, thank you, Michel, for taking the time today, and we'll hope you join us on the next episode with Anastasia on another fascinating topic, and enjoy the rest of your day. Thank you.